Good morning, everyone, again. Welcome to the Genghis Investor Briefing. My name is Damaris Mukulu, the Head of Brand Marketing and Communications at Genghis Capital. This is the 55th episode of the Genghis Weekly Investor Briefing, and we have just two more before we call it a wrap for 2021. So I want to thank you for joining us today, November 15th. The Genghis Weekly Investor Briefing, the aim remains the same, to give you an overview of what's happened the previous week in the fixed income equities markets, as well as to get some macroeconomic commentaries from our research team. So our research team consists of Melody Dano and Wesley Manambo, who have joined us this morning. They're going to walk us through our presentation. In addition, they're going to tell us what to expect this coming week and also share the trading recommendations, both for stocks and for bonds. So very excited to hear that. The Genghis Weekly Investor Briefing is interactive, so please feel free to use the Q&A tab and send in questions related to the financial markets. At the end of the presentation, both Melody and Wesley will be able to answer your questions and queries, and hopefully at the end of this session, we'll be better off than we started. So I believe we're ready to begin. Our screen sharing is enabled. So Melody, over to you.
Thank you, Damaris. Just one moment to share my screen. Kindly advise if you can see it.
It's about to begin.
Okay.
It has begun at Macroeconomic Review.
Okay, thank you. Okay, good morning, everyone. Thank you for taking your time to join us today. So for the macroeconomic review, we'll start with the GDP numbers. So Kenya's gross domestic product grew 10.1% in the second quarter of 2021 compared to a contraction of 4.7% in 2020, in the same quarter in 2020. So the real GDP growth is 5.3% in 1H21, that's the first half of 2021, compared to a contraction of 0.2% in the first half of 2020. So the three sectors that recorded a growth, yes, so education, transport, and ICT sectors experienced a growth in the quarter. The quarter two growth was driven mainly by the rebound in economic activities. We've seen that there's been the easing of containment measures that have facilitated the gradual recovery of economic activity. So accommodation and food services grew about 9.1% compared to 56.8% contraction in 2020. And as we've mentioned before, mainly just due to the easing of the restrictions that had been put in place for COVID-19, as well as extended operating hours. For the financial and insurance activities, it accelerated in the second quarter to grow by 9.9% compared to 4.4% in the previous period. For the trade and storage sector, it grew 16.9%, mainly due to an increase in freight movements by SGR, that was about 25.9%, as well as high visitor arrivals from about 527 in the second quarter of 2020 to 113,307. Mainly also it could be attributed to Kenya being removed from the red list in the UK. So the sectors, however, that saw a slowdown in performance was the agriculture, forestry, and fishing activities in the first and second quarter of 2021. So the sector is estimated to have contracted about 0.9% in the second quarter compared to a growth of 4.9% in the corresponding quarter in 2020. So the sectors was pushed from a steeper slump, mainly due to increased milk production, horticultural exports, and production of sugarcane. However, the performance of the agricultural sector was aggravated by the significant decline in tea production due mainly to the unfavorable weather conditions that we're facing. For the construction sector, it was subdued, growing at a growth rate of about 6.5% in the second quarter of 2021 compared to 8.2% in 2020. However, the consumption has gone up by 29.3%, mainly to the ongoing government projects that we see, like the road here, the bypass being built here along Wayaki Way. So moving on to remittances, the inflows totaled 337.4 million in October, compared to 263.1 million in 2020. That's a 28.2% increase. So inflows increased 8.9% from the previous month, and the cumulative inflows for the 12 months to October total 3,605 million, compared to 3,006 million US dollars in the same period. So the US remains the top source of remittances into Kenya, accounting for about 65.9% in October. So we've seen that many people have been going abroad to look for jobs, and they've been sending money back to their families, also just to cushion the families as the COVID pandemic environment continues. Also, the government has been seeking on ways to optimize on these inflows, because they are proving to become an important factor in bringing in dollar inflows that are going to help to sustain the shilling. We've seen that the shilling has been having a bit of a weakening in the past few months, mainly due to importer demand. So thirdly, the IMF reaches an agreement with Kenya for 264 million disbursements. So the IMF team and the Kenyan authorities have reached a staff level agreement for the second reviews of Kenyan's economic program under the extended fund facility and extended credit facility. So this is the program that Kenya has been having with the IMF. So it's going to be receiving the loan amounts in stages. So we expect that when these funds now hit the Kenyan accounts, it's going to help to prop up the shilling at least. So the IMF team noted that the efforts to tackle difficulty of troubled state-owned enterprises, including KQ and Kenya Power, are advancing. We've seen that there's been some Kenya Power, we've seen that there was a review of the PPPs, as well as now the senior management, the some who have been suspended, so that some investigations can continue. So we can see that, we can hypothesize that for us to get these loans from IMF, we need to keep up with the disclosures, and as well as just how these state-owned enterprises that are insolvent and loss-making are going to be reformed. Thirdly, the EPRA, that's the Energy and Petroleum Regulatory Authority, announced price reviews. So as announced in its Gazette notice on Friday, EPRA announced a fuel energy cost charge of about 4 shillings and 21 cents per kilowatt for all meter readings to be taken in November, from the current 3.79 shillings per unit. However, the foreign exchange fluctuation adjustment fell to 73 cents from 1 shilling and 3 cents last month. So the forex charge is meant to cushion power firms against the volatility of the shilling against the major world currencies, that's like the dollar now. So the rise in fuel cost charge signals costlier fuel, which is deployed in thermal electricity generation. So the cost of thermal power has also been exacerbated by the increasing price of crude oil that you've seen, that has gone to about $85 per barrel. On the positive side, the EPRA also announced that the fuel prices will remain the same in this month's review. That's the same as the previous month's cycle, even with the rising crude oil prices, owing to the state subsidiary that customers have been enjoying for the last 3 months. So that super petrol, diesel, and kerosene will remain unchanged till December 14th, when the next review is going to be done. So additionally, there's something I hadn't added here, but there's the inflation adjusted excise duty tax. So the KRA is seeking Parliament's approval to raise excise tax by about 4.97%. So it's supposed to affect about 30 products. That's inclusive of bottled water, juice, motorcycles, and beer. This is going to be the first time that KRA will actually have to get a say from the lawmakers before the inflation adjustment is done. Before it was automatic. So according to the law, which came in effect in January, the Cabinet Secretary is expected to table the proposals in the National Assembly 7 days from the day of publication of the notice. So a notable exception, as we remember, there's been a lot of clamor about the petroleum prices that went up, that pushed the inflation to new high. And it was, there was a petition that was filed at the High Court. So fuel at the moment is exempted from this inflation adjusted duty. So manufacturers have mainly been stating that they believe that if we keep increasing the excise duty, it's going to lead to smuggling from neighboring countries where they have lower rates as compared to an uptick in counterfeit goods. So moving on to the next slide, we're going to look at the fixed income segment of the market. So for the secondary market segment, market turnover hit 17.9 billion. That's a 36.3% rise as the market witnessed heightened liquidity. So market activity was mainly dominated by interest in the infrastructure bond, as has been the theme in the year, as well as the longer end of the yield curve. So the CBK received bids of about 84.2 billion out of the 50 billion that was sought. That was representing about 168.34% performance, and it accepted 69.5 billion. So as we had discussed and said last week, we had noted that the 5-year paper would see a high subscription, and that was the case. It had a subscription rate of around 133.21%, mainly due to the tenor preference by banks and insurance companies. Moving on to the T-bill section, performance fell from 131.14% in the previous week to 69.27%. Mainly we attribute this to investors shifting their focus to the primary bond auction, as we saw with the performance. So the 91-day T-bill recorded the highest performance of about 99.76%, with investors favoring short-term securities, as we've seen coming out from the November auction results. In regards to yields, they went up across all tenors. So 91-day T-bill was about 7.097% on 82, 7.554%, and 364-day 8.264%. As we move on to the liquidity, so the average, the market telegraphed using liquidity with the interbank rate averaging about 4.68 from 4.73 the previous week, the week prior to that. So the daily average interbank rate, however, edged up in the from the middle of the week to close at about 5.09%. So we can see that this was because banks were moving closer to the cash reserve requirement cycle closure that usually falls on the 15th of each month. So in regards to open market operations, the CBK mopped up liquidity in the first half of the week. It accepted about 68 billion out of the 40 billion that was sought. However, after that, the central bank stayed out of the open market operations. So we are anticipating to see a bit of an improvement in liquidity because the Apex Bank is supposed to pay coupons for about 4 bonds today. So for net borrowing, we estimate it at about 356.8 billion. That's inclusive of the overdraft at the CBK. So this represents a performance rate of about 54.2%. So the government at the moment is ahead of the curve, given the prorated amount of approximately 253 billion shillings. For the macroeconomic and fixed income calendar, there's nothing major as yet. The inflation numbers and PMI numbers will come much later, but we have the T-bill auction. That's the 91-day, 182-day, and 364-day T-bill. So auction date is going to be on the 18th of November, 2021. So for the fixed income trade, our recommendation for the week, we recommend a range of 13.6 to 13.65 for the FXD1 2021-25. So this paper that's trading in the secondary market, it's paid coupons on the 8th of November. Therefore, the premium on the bond is expected to be low because not much interest has been accrued from then to date. So it also has an attractive coupon rate, which is the highest in the fixed rate series. So I'm going to hand over now to Wesley to take us through the equities segments.
Thank you, A good morning to you. The market held steady as signaled by the benchmark indices week-on-week performance. The Nairobi All Share Index peaked 30 basis points on a week-on-week comparison to settle at 171.47 points, while the NSE 20 Share Index shared 1.5% week-on-week, closing at 1919.95 points. That said, activity peaked to the tune of 50 basis points shy, double to a turnover of 3.5 billion. Looking at the week's gainers and losers, HF Group led the pack of the week's top performers on a 8.64% week-on-week rally. Stanbic, Kakuzi, BK Group, and EGADS gained 8.1%, 7.8%, 7.6%, and 6.9% week-on-week respectively. On the flip side, we had Express leading the week's laggers, shedding 17.1% during the week. Symptom, Everready, TransCentury, and Home Africa shared 14.2%, 11.5%, 10%, and 9.8% week-on-week respectively. Looking at foreign participation, foreign investors accounted for 45.8% of the week's turnover. They sustained a bearish outlook with outsized exits on Safaricom. In addition to Safaricom, they exited on BAT, KCB Group, and EABL, while accumulating on Equity Group to clock a general net outflow position of 848.61 million. Safaricom released their half-year results on Wednesday. They printed a 92 cents half-year earnings per share. Looking at their top line, M-Pesa revenues came in at 52.3 billion, while voice at 41.5 billion and data at 23.6 billion. Their OPEX came in at 23.4 billion. Comping through the numbers against our half-year estimates, their half-year earnings per share print came in 7 cents above our expectation. The outperformance was primarily driven by the lower than forecasted cost environment. Looking at the top line, we were impressed by M-Pesa revenue contribution that stands at 37.8% of the total service revenue. And the solid performance was primarily on the back of a 51.5% year-on-year growth in transactions. There was also a 31.3% rise in 30-day active M-Pesa revenue users, and also the lapse of the zero-rated transaction boosted the revenue growth in M-Pesa. Looking forward, we expect M-Pesa to become a billion-dollar business with our full-year forecasts at 118 billion shillings and its average revenue per user at 300 shillings. Moving on to mobile data, revenues came in below our projections by about 2.6 billion, broadly on account of price elasticity. That said, we were impressed by the 26.7% year-on-year rise in data customers using more than 1 GB of data and the sustained growth in active 4G devices. We maintain our full-year data revenues projections at 52.6 billion, and the data voice and the mobile data average revenue per user at 204 shillings. Looking at the fixed services, they came in line with our estimates, and we believe that the return to office following the easing of COVID-19 restriction will be a major boost to fixed enterprise revenues. We maintain our full-year forecast of service revenues at 11.1 billion, which is a 17.1% year-on-year growth. Voice and service revenues sustained a downward glide in average revenue per user, And this is largely on account of customers embracing over-the-top technologies, and we believe this will be a major headwind going forwards. Looking forward, we expect costs to remain elevated as Safaricom enters Ethiopia. CapEx is expected to continue rising as operations in Ethiopia take ground and as the company implements its strategy of transforming into a tech company. Without much surprises on our half-year expectations, we retain our full-year projection and expect a strong full-year top-line print to the tune of 300 billion with a 1 shilling and 91 cents earnings per share. Looking at the sub-Saharan market performance, the Nairobi Oil Share Index dwindled below its peers on a week-on-week median comparison. Also on the corporate calendar, we have Kabasid's 1 shilling and 60 cent dividend, which will be with a book closure of 26th of November. We'll communicate on KenGen's book closure once we touch base with management. To you, Melody.
So thank you, Wesley, for that. So we're going to move to the for the financial markets review. So looking at market performance for the banking sector stocks, we see that HF Groups recorded the highest gain, closing at 4 shillings and 15 cents. That's 8.6% higher than the previous week. Mainly it's due to the announcement of the search for a strategic investor. That's what we open. Also, Equity Group, about 5.2% rise week on week. BK Group, about 7.5% week on week rise. So generally, the banking stocks have been more or less going up, other than ABSA and NCBA Group. For the insurance sector, the stocks were mostly bearish, with just Kenya Re going up 0.4% week on week, with the rest of the counters reporting a decline in prices. So we are expecting some heightened activity in the banking sector stocks as the Q3 results roll in. We are waiting the financial results for KCB on the 17th and for Cooperative Bank on the 19th. So DTB, it rose just marginally. They had announced that they are going to launch a China coverage department. So that's going to, in a move to bank Chinese enterprises operating in East Africa. So looking at the sector highlights, so the CBK has actioned the CRB listing freeze order. So the CBK has directed financial institutions to begin effecting an order directing the freeze of new CRB listings of loan defaulters of the sum of below 5 million shillings. So Kenyans with loans below 5 million that were performing but fell into defaults after October 1st this year will not be listed. The CBK also noted that in making this recommendation for the suspension, it was cognizant of the need to balance between providing relief to SMEs and actually safeguarding the effectiveness and sustainability of the CIS framework. So a good credit record, it demonstrates that the borrowers has creditworthiness and should lead to essentially a lower cost of credit. So basically the CBK was saying that the suspension could adversely affect the provision of credit by banks to the target groups, and they'll be unable to distinguish between good and bad borrowers. So Kenya's private sector growth still at single digits. So we've seen the banks are still cautious on lending and are preferring to instead lend to the government that's now investing in T-bonds and T-bills. So secondly, Kenya explores central bank digital currency for cross-border payments. So speaking on the sidelines of the Afro-Asia FinTech Festival that was held virtually, that's Dr. Njoroge stated that these CBDCs, they can slash the time needed for cross-border payments, in addition to cutting costs. So he has confirmed that CBK has plans for CBDC, arguing that they enhance efficiency and as long as other countries work together. So this is money that exists solely in electronic form, issued and regulated by the nation's monetary authority, and it's backed by the government. So Dr. Njoroge also noted that CBK is in discussion with other global central banks in the possibility of introducing the CBDCs. So that's according to the ABSA financial index. So CBK, alongside with Eswatini, Ghana, Mauritius, Morocco, Rwanda, Nigeria, and South Africa, that are exploring the use of these digital currencies for retail purposes. Though some experts are, however, against the use of these currencies because they're not designed to fulfill any classic function of money. That is a unit of account, a store of value, or a means of payment, because the prices are extraordinarily volatile, as we've seen with the case with Bitcoin. Thirdly, Equity Group released their third quarter 2021 results. So the pre-tax earnings came in at 3.39 shillings per share. That's a 5.5% rise quarter on quarter and 64.38% rise year on year. So the Kenyan operations contributed 90% of the nominal profit before tax. And from observation, the performance of the quarter was driven mostly by funded income. So total gross income for customer loans and annuities from investment securities rose 23.1% year on year to 23.5 billion. And Kenya contributed 72% of the year on year nominal growth. So the loan book grew by 23.2%, while investments in total investment securities portfolio surged 62% year on year. So the annualized net interest margins, they remained soft during the year, declining about 20 basis points. And we can see there's some dislocation between the growth in interest, between earning assets and income. So interest income for loans grew about 15.6%. Notably, there was a rise in balance sheet funding costs during the quarter. So the group's interest expenses rose about 50%. And it appeared that the growth in these funding costs came from non-Kenyan operations. Additionally, the cost of funding, Kenya's cost of funding increased 39% year on year. So this rise in cost of funding is unprecedented given the bank's strong franchise. So in the total operating costs rose 17% year on year to 13.5 billion, and mostly it's been attributed to South Sudan, Tanzania, and DRC operations, with Kenya only contributing half of the nominal growth. So efficiency levels in South Sudan worsened to 93.5%. In Tanzania, it declined to 64.4%, but it's still quite elevated. For DRC, went up 73.5%. But overall, the group's cost-to-income ratio stabilized at around 51%. And it appears that the bank has successfully integrated much of its costs arising from BCDC acquisition in Q4 2020. So the group continues to claw back loan impairments. That's one of the reasons why we saw the profits go up the way they did. Though there's some dislocation between market risk judgments and the prevailing risk environment. So we're not completely out of the woods yet. So the lifting of the provisions may be a bit, let's say, we need to still be a little cautious and hold on to some provisions, but let's wait and see. In terms of asset allocation, the group continues to invest liquidity in investment securities, and the group's portfolio of securities grew 62.1% year on year. That's towered the 23.2% growth in the loan book. So we can see that still banks are preferring to as I'd mentioned before, to lend to the government more than to lend to the private sector. And I think that's it from my end. Wesley, you can take us through the equity trading idea for the week.
Sure, Melody. Our risk-on trading idea for the week is a speculative buy on Safaricom. We believe that key revenue lines shy of SMS and to some extent voice will keep on a steady performance, making the counter a good long-term pick. Key concern remains the heightened political risk in Ethiopia and its potential impact on the 30% premium the market attached to the stock on news of entry to Ethiopia. If the political risk crystallizes, then we see some erosion of this premium. However, we do maintain a cautiously optimistic stance on the venture on the back of its time horizon. Back to you.
I think that's the end of our presentation. Damaris, you can go back to you.
Okay, thank you, Melody and Wesley. Thank you for that presentation. It was short and clear. We've gotten plenty of questions today, both on chat, Facebook, and on our Q&A. So let's dive in with the Q&A ones first. So we have a question from Joseph addressed to you, Melody. Are there any key implications of the macroeconomic developments for portfolio investors? For example, opportunities or risks in key sectors, or implications for shilling strength or weakness, inflation, etc.?
I'd say at the moment, we're still in a recovery progress. So we're just observing to see what will happen in the economy. So it's still a bit early to tell where exactly there will be risks and opportunities in the sectors, but we've seen generally economic activity has been picking up. In terms of inflation, we've seen that the cost of crude oil, for example, has been going up. So we might see some effect on that later on, with costs being transferred by the manufacturers. So I'd say, let me look at this more into detail, then we can get back to you on that one.
All right, so Melody, you'll remember to address this next week's session.
Yeah.
All right, awesome. Cliff is along the same lines. Cliff is talking about inflation. So inflation head seems to be roaring high. Is the unchanged fuel prices a precursor to higher prices during the festive season, the calm before the storm? Last time the prices remained unchanged. At the next review, there was a significant increase. I know you spoke a bit about this. Would you like to elaborate?
So we could say that it could be the calm before the storm, because essentially the crude oil prices have been going up. They've been hitting about $85 per barrel. That's quite high. And though the government is at the moment keeping the prices stable, we're yet to see like how long that will continue being done. We've also seen that there's some reforms that are supposed to be done by the parliament. There was a report that they've done to slash like the VAT on LPG and fuel as well. So we're going to see what will happen in terms of fuel costs. But we've seen that the food prices have been going up. It was, I think, even in today's paper, that it's a precursor of what's going to come in the next month. So generally, because of the supply bottlenecks that have been experienced throughout the globe, we're going to see some form of inflation still coming up in the coming months.
So let us brace ourselves.
Yes.
All right then, Cliff, I know you've taken note. Kamal has a question, actually 3. I can answer 1, yay. Let me start by answering the one I can. Kamal, you're asking where you can get last week's recording. Please find it on the Genghis YouTube channel. So just search Genghis Capital on YouTube and you'll find our channel. It was episode 54, I believe. So you'll be able to see it. The other 2 are for you, Melody and Wesley. The first one is, what are the best counters to buy from for positive returns in the next 6 months? I don't know. And secondly, what is driving down the shares of BAT?
Those are interesting sets of questions. Let me handle the second one. Okay, yeah, that's a good observation. BAT shares have been having a decline trend, and it goes without saying that BAT products have a guarantee-ready market, and they need no advertisements. They produce, they have a ready market, which leaves the regulatory environment as the major headwind that the company faces. I tend to believe a stick of cigarette goes for about 15 shillings. And from a chat I had with a pal a while back in the industry, she told me that 50% or even more, depending on the product, goes to settle tax obligations. So the uncertainty in the tax environment is a key headwind on the company. On the first question, which are the best counters to buy from the positive returns in the next 6 months? Melody, do you have some comments on that?
Well, for me, I would say mostly the fortress stocks. That would be like the banking sector counters. And also the ones that are undervalued, like Kenya Re, the price to book ratio is quite low compared to what they actually, the value of the company. So KenGen as well, it's revenue diversification strategies. Though you can't really give like, there's no exact stock that you'd say would be the best, but I'd say just basically looking at the company's fundamentals, the balance sheet, how is it looking? The assets to liabilities, are they having negative working capital? Such things are supposed to look at, just how strong is the company. But mainly just the fortress stocks, for me, that would be the banking sector counters.
All right, thank you very much. I think something of interest to mention, although we are, I think, still 7 weeks or 8 weeks before the end of the year, is that I'm sure everyone is aware that every January, Genghis releases a Genghis playbook for the entire year. So usually in this publication, just like there was the one for 2021, we give an overview of expectations for different kinds of investors, from investors who are looking for returns, income, whatever it might be. So I think Melody has given us good advice, but if you want to start 2022 on a good footing, just keep an eye out for the Genghis playbook. They say it was a conference. I don't know what format we'll take for next year, but that should be interesting because they put all their thoughts and predictions and recommendations and stock model portfolios in there. So something just to think about. Now, Peter joined us from Facebook and then joined us on Zoom. He has questions related to day trading. So Wesley and Melody, I hope you are updated. So his first question is, with the introduction of day trading, will they scrap off the current T+3 settlement days? I tend to not think so, because I think day trading is very different from share settlement, but I'll let the experts advise us. And he also wants to know, will there be withholding tax on capital gains related to day trading? So over to you, Wesley and Melody.
Well, for those ones, we'd have to confirm, we'll confirm with the dealing team so that they can be able to tell us more about the day trading. But we note that they had said that they've put the requisite infrastructure enhancements to ensure that the day trading is going to be possible. So we're just going to confirm if now this is going to mean that the T+3 settlement period is going to be removed or not. On terms of withholding tax on capital gains, we'll also have to confirm on that as well.
Okay, so I know Dora is on the call. Dora, could we find Peter Ndungu's email address and then share it with Melody and team so that we'd be able to email him in the course of today with the responses? I know Dora is here. She's taken good note.
Sure, Damaris, will do.
All right, thank you so much. So Peter, please expect an email with a response. We'll be sure to also, hopefully we will remember, to share with everyone else on the call in case there's someone else who was also interested. Kevin is asking a question about IFBs, and I know I can link it to the one that was asked on chat. So Kevin's question is, What should someone look out for when buying or selling infrastructure bonds in the secondary market? Allow me to add Titus's question. Not Titus, sorry, Kimutai. Kimutai was asking whether you would recommend a buy on the IFB in the secondary market. So those are two kind of related questions. I don't know how many IFBs are currently in issue, but Kimutai wants to know if you would recommend a buy. And Kevin wants to know what to look out for when he's trading in them. And then we'll go to the other questions on the chat.
I'd like to find out, is Ian in the meeting?
No, I tried reaching him on phone. Oh, he has just joined. Speak of things. Although Ian, sorry, go on.
I think he can be able to give a succinct answer, a bit like a heavier answer.
All right. Ian, I can't see your microphone, so maybe you can troubleshoot and we can answer a couple of questions before we come back to them. So Kevin and anyone's question on infrastructure bonds, will come back to them. I won't mark them done. Ian, please try and activate your microphone. Let's move to Wangai. He says, or rather, views on Symptom. With the recent price drop and rumors spreading around of cash flow problems, laying off of employees, does this as well affect counters such as Longhorn, where they have a huge shareholding? So a question on Symptom, or rather Longhorn.
Oh, okay, Wesley, you can take that one.
Okay, then you'll give your high-level thinking and add on what my 2 cents. Well, the market is known to price in news, whether true or not true, whether heavy or not heavy. The market always prices in news. So on this specific news, yes, it's specific to Symptom. Talking of Longhorn, that is quite a separate entity, and it has its own direct drivers. So in an indirect way, we really don't foresee an influence from this specific news, because given its performance and its outlook for the financial year, it's quite positive for a standalone. Melody, any additions?
I think you've covered the question well. So essentially, Longhorn, the performance of Longhorn should be separate from Symptom because of of its performance during the year. So essentially, Symptom's performance, its own books, shouldn't necessarily affect Longhorn's valuation.
All right, thank you. I see a question from George McCurry. He's asking about any possibility of rates going higher. George, maybe you could elaborate if you mean rates for Tbills, the ones that Melody and Tim were talking about, or which rates specifically? I'm hearing voices.
I'd say if maybe it's for the CBK base rate, we don't see it going up just yet. We've seen that the core inflation has been actually subdued, so that decreasing demand, as well as inflation, it's still within the range of 5 plus 2.5 minus 2.5%. So at the moment, we don't see the CBK raising the base rate at the moment, but it's still something to keep an eye on because inflation can still creep up on us.
All right. He has elaborated, Melody, that he meant the Tbills rate.
Okay. So we've seen that that's been edging upwards. So I think for the moment, I think they'll still continue going up.
All right. Any reason why they've been edging upwards?
So I'd say maybe, I don't want to speculate on that one. Let me get the correct answer to that. But given from the historical, like what has been going on, the yields have been edging up. There's a time it had gone down when there was quite a bit of liquidity in the markets. But right now, we've seen that it's been a bit tight here and there. And also we are going into the election period. So that could be one of the reasons why we're seeing it going up.
All right. Still on T-bills, Ndungu is asking if he buys a 364-day T-bill, can he trade it on the secondary market before it expires? Ian, I think your microphone is active. Maybe you could address that.
Hi, how are you all?
We're great.
Apologies that I'm coming in quite late. Okay. I was in another meeting, and I think most of you are aware. So on what Melody was actually answering in terms of why the rates for T-bills have gone up, we have seen a little bit of increased liquidity in the market, and that is what has subjected even the rates for the T-bills to go up. Then again, the government has had a lot of obligations in terms of what they would, in terms of the obligation, in terms of the coupons to pay. So when they have so much coupons they want to pay, what happens is they will take whatever bids that are there for the T-bills just to meet these obligations. So on whether a T-bill can be traded in the secondary market, that's very much possible. It is done through what we call over-the-counter. It is not done in the system like we see with the T-bonds. But it is quite rare. It is quite rare because for a person to buy a T-bill in the secondary market, it is very rare. Out of like this year, I think I've only traded just one trade for the T-bills, and it was for a bank. So it is quite rare to trade the T-bills in the market. Yes, secondary market, that is.
All right, awesome, Ian. And now that you have joined us, we have several questions about IFBs. The first one was whether we would recommend a buy on the IFB. The person who asked the question didn't specify which one in particular, although George McCory says there are 20 active IFBs. I am pleasantly surprised. So this is Kimutai. Would you recommend a buy on the IFB in the secondary market? And we were tying it to the other question from Kevin on what should someone look out for when buying or selling infrastructure bonds in the secondary market?
Well, that's a very good question. Well, it is always advisable to buy IFBs, especially the IFBs that have been issued by the government this year. The one for January, it has a coupon of 12.257. The one for April, it has a coupon of 12.67, and the one for September, 12.737. And of these, they're tax exempt. Yes, they might be a little bit expensive in the secondary markets, but we can always recommend for investors to buy the infrastructure bonds, because the aspect of them being tax exempt, you're getting your coupon as it is. Vis-a-vis what you can get in fixed rate bonds, whereby you will be taxed on the coupon. So it is always recommended for us to buy the infrastructure bonds. But what we advise is buy an infrastructure bond when it has just issued coupon, so that you do not have a lot of accumulated accrued interest. Because when you buy a bond, when it is approaching, when it is going to issue a coupon, it will be a little bit expensive. So we can always recommend, once a bond issues, that is an infrastructure bond. Like today we have IFB 12069. It has a coupon of 12.5%. It is issuing coupon today. So we can even recommend to investors, take advantage of that, because the prices from tomorrow, there will be no much of accumulated accrued interest. So you can always get in at that point in time. Yes.
Perfect. Thank you. That's very clear. It's got me excited. I want to buy an IFB myself.
Please.
Norman is asking something. I don't know if it was in the presentation, maybe it passed by me. He says that we talked about a fixed income paper that will earn 13%. Is there a paper that's earning 13% at the moment?
Yes, we have a paper in the market that has a coupon of 13.924%, but that is subject to tax. It is a fixed rate bond, so it is subject to tax. So ideally it's 13.924. Then the paper is a 25-year paper, so you have to there's a withholding tax of 10%. So yes, it is 13%, but subject to withholding tax of 10%.
All right, Norman, if you are still interested in this particular paper, or anyone else is interested, please send an email. I think I shared the address in our chat to the client relations team. They also work with Ian, and they'll be able to advise you further on how to take up the opportunity. Churchill, it's really good to see you. Thank you for offering me your IFB. I don't want to sell, I want to be gifted for Christmas. I think you need to say exactly what it is you want. I want an IFB for Christmas. Okay. Soldier and Ian, thank you so much for your answers. They're absolutely brilliant. I hope you'll stick around in case we have others.
Yep, I'll be around.
All right, thank you. Going back to the Q&A, I have Titus here who's asking, what are your thoughts on investing in index fund options, which are available on the NSE? Do they offer good returns equivalent to stocks?
No.
Yes, Melanie?
Okay. So for in terms of returns, we'd have to find out more about that, but we can just tell you about the advantages of using indexes. So they basically use an easy way to track the overall health of the markets. So just by looking at this one measurement, you're able now to tell the current state of the markets. The only disadvantage is how the stock index is calculated, just the weighting of the stocks. So stocks with higher prices tend to have a larger impact of movements, like let's say like Safaricom, its movement in prices can have an impact on the index itself. So in terms of returns, we'd have to look more into that about index fund options trading. But those are just some of the things to look at, the advantages and disadvantages of using indexes to trade.
Okay. We have another question from Joseph who's asking, Melody, what direction do you think banks' non-performing loans or provisions is likely to take in the short to mid-term?
So what I can do, I just saw that the CBK had released the credit survey report for the quarter ended September. So they noted that the NPL ratio has improved a bit from 14% to 13.6% in the quarter. And so we can say mainly due to the increased recovery efforts by banks. And mainly we saw that they've said that some are expecting it to go down, some are expecting it to come out. I think 40-something% expecting NPLs to come down. So generally, we're seeing that with the markets improving, with the resumption of economic activity, in the short term, I believe that non-performing loans would go down, though they're still above the pre-pandemic levels. But essentially, the non-performing loans book, the asset quality should improve in time. In terms of provisions, we might see them. We've seen banks are still letting go of their provisions, and that's why you see they've been having some good results. However, the economic conditions, it's not like we're completely out of the woods yet, because anything can happen. We can have new strains and such. And also we've seen that now, because of this blacklisting freeze, we might see now banks either offering up their provisions just in case the loans that they've given out, those ones that are below 5 million, in case they go into default, they may just decide to be prudent and have more provisions in place. But generally, we're going to see it coming down, both the NPLs and the provisions.
Okay, thanks so much, Melody. I know this MTN for the IPO for MTN has created a lot of speculations, and unfortunately, I think for the past month, we've been saying the same thing, that it's not within our coverage. Alex, I would just advise you to do some market research and perhaps find a partner who is offering people the opportunities to take up the shares on offer, and then they'll be able to guide you further. And Dungu, thank you for your suggestion. Melody, Wesley, and team. He notes that since securities trading is going live next week, we should perhaps incorporate some information on the capital gains tax, etc., the do's and don'ts in our next presentation, which we really do love getting suggestions and enriching. So we'll definitely look into that. Robert is concerned, or rather he wants to know your opinion on Kenya Power being reported bankrupt. Would we still recommend a buy on its shares? I'm going to say a solid pass, but I think the experts put some reasoning behind it.
Yes, I'd take the same sentiment with you. I would, in my opinion, I would not recommend a buy on its share, at least not at the moment. Seeing that it's been facing some headwinds in terms of the PPPs, they're found to be quite expensive. The issues with the procurement, with the fraud, with the basically the issues that have been faced by the company. Though the IMF had set out like conditions that KPLC should undergo some reforms. Nimeshema kidogo. KPLC should undergo some reforms. I believe at the moment it's a bit too early to tell the direction of KPLC. We've seen also that there's some managers who've been suspended just to give room for investigations. So at the moment, I would not advise on buying shares on KPLC until we see some tangible, succinct like results of these reforms. So at the moment, I wouldn't recommend it.
Thank you, Melody. I concur. Okay, so our last question for today from Titus. With the shilling facing headwinds against the dollar, how will this affect agriculture sector earnings reports? Someone has a need to receive. Where's
Okay, let me take that one. Okay, with the general knowledge of a weakening domestic currency stimulating exports while making imports more expensive, and conversely a strong domestic currency hampering exports and making imports cheaper, going by that concept in mind, we expect to see a positive on these agricultural companies because they're main exporters, and also on account of the weather being friendly. I think global warming has been friendly to this, especially the tea and the coffee with more longer short rains. We expect to see something good on their end.
So that sector is going to be affected positively with the headwinds against the. Okay, perfect. Thank you so much, Wesley. Let me just do a quick scroll through chat just to make sure we have addressed everyone's queries. George, Ndungu, Churchill, everyone, thank you so much for your suggestions and offers. David, I see you've shared with us our contact details for integration. I would actually request, if you are this particular person, if you could reach out just to our IT team on IT at Genghis Capital, that would be great. I believe that covers it for our Q&A. Today it's been longer. I want to thank everyone for the session today, all the attendees, both on Zoom and on Facebook. You guys have been great. It's been interactive. Thank you, Ian, for leaving a meeting and jumping into this one to address our queries. Thank you, Wesley and Melody, for always showing up and giving us the best that you have. And I know the next two briefings, because there are just two left in this year for us, are going to be interesting. I am personally looking forward to learning more about day trading. Maybe you could have like 1 or 2 slides and just educate us on day trading next week. That would be awesome and something for us to all look forward to. Otherwise, we wish everyone an awesome investing week. Be sure to reach us through our social media platforms or on research at Genghis or marketing at genghis-capital.com. We will see you next Monday.